Everyone thinks you can't buy anything for 500k worthwhile in Australia anymore. And well, it is getting hard, but it's not impossible. Today, I'm going to show you 3 goldmine suburbs where you can still buy a freestanding house with yields between 4 to 6% under 500k. Not only are these freestanding houses with good rental yields, but these have huge capital growth potential as well. These are the opportunities that everyone's missing whilst investors are still chasing the old hotspots like Perth or Adelaide or Brisbane. I'm Ben from Compound Property Buyers Agency, and we have bought hundreds of properties in the last 18 months under $500,000 for our clients. All of these properties have grown exceptionally well, but I'm going to show you 3 actual examples of properties that have grown between 20 to 40% in a 12-month time frame. These aren't hypotheticals, these are real client examples getting real wins and building true property portfolios. Here's what we're going to cover today. Firstly, I'm going to show you 3 examples that we've bought in the last 12 months and how they've performed. Then I'm going to go into 3 goldmine suburbs under $500,000 with exceptional capital growth opportunity. And then I'm going to show you an example of a suburb that you need to avoid and the metrics that you need to look out for. Before I show you where to buy now, I'm going to show you that our method actually works. So these are 3 deals that we've bought in the last 12 to 18 months under 500k across the country. So here's the first example. This was a property in Eaton in Bunbury, which is a regional location in WA. And if you look up how it's performed, it's been very, very strong. This is a 3-bed, 1-bath property on a whopping 858 square meters of land. Now, the purchase, we did this in February 2024. We paid $475,000 for it at the time. We have now had it valued around, we're pushing 20 months later at $650,000. And you can even see on realestate.com it's showing high confidence at $638,000. That means the equity gain has been $175,000 in 10 months. The gross yield at the time was 6% and the property type was a house. The lesson for this property was picking a solid foundation property. So we had a brick build, good block size, solid rental yield at an affordable price point, but most importantly, picking the right time of the cycle. So Bunbury, very strong regional centre, had not performed very well over the previous decade, but all the data metrics were pointing towards it going extremely well. We had tight supply, we had low vacancy, we had high affordability local to average incomes, and that is why it has performed so well and continuing to do so. Let's go to example number 2. Now, this is an area called Gracemere, which is in Rockhampton in regional Queensland. So we bought this property also in February 2024. So you can have a look at the property. This is a newer type of property. It was a 422 on a good block size as well. So the block size, 714 square meters. At the time, we paid $462,000 for this property. The current value as of December is $670,000, which is quite incredible. The equity gain on this property is $208,000 in not very long at all. The gross yield at the time, now this one, it was roughly 5.5%, but the rents have since increased. So it's over 6% yield now. Also, being a newer style property, it does have good depreciation as well, which does help for the cash flow. I'm going to do a video on depreciation. It's not a reason to buy a property, but it does help with the cash flow. And I'll talk you through that at that time. The lesson here was, once again, we picked a really solid, strong market. So this is Rockhampton and Gracemere, which is a kind of a suburb of Rockhampton. Once again, had not performed for a long time. If you look back kind of 10 years, it was quite an underperformer. But what we saw were things were changing and had a diverse economy, agriculture, services, transport hub, and all the metrics of data were really showing strongly as well. So we had low days on market, we had tight supply, record low vacancies, increasing rents, and we knew that it was the time to buy. Just on this one, like every other property, we bought it really well too. We bought this off market. At the time, it was probably worth $480, $490, and we picked it up for $462. So you always got to buy well as well. Now let's go to number 3. Now I love this property, not because of the property, but because how it helped a young client get really ahead quite quickly. So this was a suburb of Gladstone. Now Gladstone in regional Queensland has a bit of a checkered past, bit of a boom and bust town, but we're picking it up at the right time. So if you look quite incredibly, we paid in April 2024 $411,000 for this property. It was sold in 2011 for $421,000. So in 13 years, the property had lost around $10,000. So most people would look at that and absolutely freak out. For us, that couldn't be a better opportunity. So We bought it in April 24. We paid $411,000. It's now valued at $560,000, which is an equity gain of $149,000. So you think about 13 years of no growth. We've had 13 months of 150,000 or more. So it's incredible to see what good timing can do. Yields around 5.5% to 6% as well. And the lesson here was Gladstone has a bit of a checkered past, as I mentioned previously. There was some big, I believe it was gas projects. They sent the market like crazy. People were paying huge amounts of money, particularly for the rent that they were getting at the time, because it was all through the gas and mining projects. But what we saw now was an area that had a long period of stagnation. The economy had started to diversify. The metrics started to line up nicely. We had strong days on market. We had strong affordability to local incomes. We had a tightening vacancy rate, and we were buying these properties well below replacement as well. So they could only really go one way. And as we've seen, 36% growth in around a 12-month period, which is pretty incredible. So when we look at these three examples, what are the patterns that we see? Well, the first thing is we bought them all under 500K, and that's what I'm going to show you today. The three suburbs, you can still do this. They all delivered strong yields. Now, each state is slightly different. So these were Queensland and WA, so we could get strong yields at the time, 5.5% to 6%. Not always possible, but that's what they had. They all achieved 25 to 45% growth in a 12-month time frame, and the way we've done that is by picking the right time of the cycle, and they all created 150K or more of equity. So the average return across these properties was 39% in a 12-month period, and the average equity gain was $177,000 per property. These aren't projections. These are real numbers that have happened, and these are life-changing results for our clients to be able to then go into another property from these purchases. But here's the critical point. The markets that I just showed you, Bunbury, Gladstone, Rockhampton, these are not the markets of today. Yes, they will continue to keep growing, but they're not going to grow at those exceptional rates. You need to stop buying in certain areas at certain times and start targeting the next undervalued suburbs, and that's what I'm going to show you today. Now, let me show you three suburbs that we're actively buying right now with a 500,000 median, where you can still buy a house with rental yields of 4 to 6%. So the first suburb I'm going to show you is actually in Victoria, and it is a suburb called Eagle Hawk in Bendigo. So Bendigo is a large regional centre. It's roughly 150 kilometres from Melbourne, around 90-minute drive. Some of my family's from there, not that that matters. It is a population of 121,000 with expected growth to 150,000 by 2036. So strong population growth. Now, this suburb has a median suburb price of 531,000, but you can still buy properties under that. And it's got affordability of 33 years to own. So very, very strong. So let's have a look at the example. So if we go to Golden Square, Victoria, so you can see here, we've got a 3-bed, 1 bath, 1 garage on 500 square meters. Now, this is a brick build, well-maintained, older style property. Look, there are a few things that you need to be mindful of. It is on a slightly busier street. It does look like it has some commercial behind it. But the point here is you can still buy a property or a freestanding house for $460,000. You can see that was sold in October 2025. This is not one that we actually bought. We actually did reject this property, but I want to give you an example of a property that you could buy with the price point. So why is this a Goldmine suburb? I'm going to take you through a few really important metrics and we're going to talk through it. So there's kind of two ways that I like to look at a suburb. One is, what's the 10-year growth? In other words, how much performance has it had? So is it a steady performer? And then what's the 3-year growth? So for the 10 years, we want to see a high number. For the 3-year, we don't want to see too much growth because it means it's got more in the tank. So the 10-year growth of this suburb, 102%. So it's averaged 10.2% over the last 10 years. The 3-year growth suburb is only 5.5%. So it means it's really underperformed in the last 3 years, which is actually what we want to see. We don't want to be buying the market that's done 25% last year, right? Unless it's the first year, but we don't want to be buying towards the end of the cycle. The stock on market here is 0.22%. So the supply is extremely tight. We've got days on market of 33. Now, just so you understand, 60 is a balanced market. When it starts getting below that, it starts really tightening. It means things are selling really quickly. We've got a vacancy rate of 0.68%, so it's really strong, super tight, easy to get a tenant. We have a renter to owner ratio of 29%, i.e., 71% of people that live in this suburb are homeowners, which means it's a strong owner-occupier appeal. And we have affordability of 33.88 years. So the way that that metric is calculated is anything at 40 years is a balanced market as far as affordability. So there's some suburbs in Sydney that are 60, 70, even 80 years to own. We like to target properties that are kind of 20 to 35 years to own. So this is sitting at 33.88, so still very affordable. So they're the data metrics, but why is it a gold mine? I'm going to go through 3 reasons why I think so. One is infrastructure. There is plenty of investment happening around Bendigo. We have the V line, which is connecting Melbourne to Bendigo as far as commutable work. And we also have the 1.1 million redevelopment of the hospital, which is a significant project. The second is the future potential of Bendigo. As I mentioned earlier, the population is going to grow from 121,000 to 150,000. There is major employment drivers. So we've got healthcare, we've got construction, we've got hospitality, we've got education, and a number of different services. The third is a low unemployment rate. We've got unemployment sitting at 4.2%, which is in line with the state average and shows that there are a number of job opportunities in regional Victoria, in Bendigo specifically. And then the third is the owner-occupier appeal. There has been a push to the regions across a number of states in Australia, and the reason for it is it's much more affordable lifestyle. It's only a 90-minute commute to Melbourne, so it attracts a lot of young families that are priced out of Melbourne and want a better life. But you can't just buy any house. The things that you need to avoid in this suburb, you've got to be careful of things like public housing. You can't buy in too high a public housing area. You don't want to buy on the fringe of the suburbs with a lot of new development, and you want to follow the usual due diligence of properties. So not in a main road, not near retail precincts, not in a T-junction, all the different types of due diligence that we follow. Now let's go to Goldmine suburb number 2. The next suburb that we're going to focus on today is Mildura. So this is a very different play because it's not strategically located near Melbourne. This is a standalone diverse economy right up between kind of South Australia and Victoria on the border of New South Wales. So let's have a look at Mildura. So as far as location, this is 550 kilometres away from Melbourne. So it is a different play, this one. It's a much more standalone regional centre. It is known as the Victoria's Food Bowl because it's got major agricultural production happens there. Population is currently 57,000, but it is expected to grow to 62,000 by 2036. The median price, very similar to Golden Square, is 514,000 for this property, and the affordability is 29.68 years to own. So we have bought many properties in Mildura. I'm going to show you one that we bought earlier this year. So this was a 3-bed, 2-bath, 2-car garage on 720 square meters. Now you can see here, we bought it actually this year, January 2025, and we paid $442,500. Sometimes that extra $500 we use to negotiate. And if you have a look here, realestate.com has shown that it has grown 16.7% since we bought it. So we're still filming in the same year. So it'll probably have 20% growth or more in 1 year. Just goes to show you again, once if you get it right, the timing. So this was a very simple 3-bed, 2-bath, 2-car garage, nicely presented on a large block in a quiet street. Really ticks the boxes of what we call a foundation property. Now, let's have a look at the numbers of Mildura and what makes this a Goldmine suburb. Remember what I said about having a good 10-year history. This Mildura has had 110% growth over the last 10 years, which means it's tracked nearly 11% per year over the last 10 years. However, the 3-year growth has only been 22%. So you can see it's sitting below its average growth, which is what we're looking for. The stock on market is super tight. 0.42% means there's hardly anything for sale. The days on market, things are selling very quickly. They're at 30, so even less than Golden Square. Vacancy rate, 1.09%. Now, what I've noticed in Mildura, it fluctuates quite quickly because it's not a large place. So sometimes you get a few more rentals that can spike the vacancy and then suddenly they get taken really quickly and then it drops quite dramatically. Rented to owner ratio, 37%, so very strong now. It's very similar to Golden Square. Anything above kind of like 40% is when it starts to become a bit more of a focus, and 50% you'll see in some suburbs or even 60% in some as well. So 37% very strong. Average across Australia is a roughly 30% investors to 70% owner occupiers. So you kind of want to be around that average. And the affordability is very strong, sitting at 29.68 years. So you remember I said anything under 40 is good. So we're sitting nice and affordable, which is great. So if we have a look at the 3 reasons beyond the data why I think Mildura is a gold mine. One is infrastructure. So there's a number of projects that are proposed for Mildura. One is a proposed airport upgrade. The other is the $2.3 billion Energy Connect project, which is happening across a number of regions between Victoria. There are various solar farms being built in Mildura as it kind of moves into renewable energy area. And there is a number of medical marijuana projects happening there as well, which is becoming a new industry. As far as the future potential for Mildura, the population is growing, as we saw. Medical marijuana is becoming a real industry there. It continues to be the food bowl of Victoria. And the reason for that is it has a beautiful climate. It's also got strong tourism too, sitting on the Murray River. So it's a beautiful scenic location. As I mentioned, the renewable renewable energy sector is becoming a big part of Mildura's future. And then the third is owner-occupier appeal. So once again, this is an affordable region. So it gives people from Adelaide or Melbourne an opportunity to move to a much affordable lifestyle. It's a beautiful scenic place. So a great place to bring up the family. It's got a beautiful climate and it sits on the Murray River. And the other thing is it's got a very strong economy. So it's not reliant on the capital cities like Melbourne or Adelaide. It has enough diverse economy to rely on itself. And that's why the low unemployment is sitting around 3.2% under the state average. It's also a great place for retirees as they go and enjoy the warm climate in an affordable location. Okay, so let's go to Goldmine suburb number 3. The third suburb, Goldmine, is a contrarian pick, and this is an area that a lot of investors are avoiding, but I see a lot of opportunity in this area, and that is the area of Traralgon, which is part of the Latrobe region in Victoria. So let's have a look at it. So Traralgon in Latrobe Valley, Victoria, it is 160 kilometres away from Melbourne, about 2 hours east of Melbourne. It's part of the Latrobe region, which is made up of kind of 4 satellite cities. So you got Moe, Morwell, Churchill, and the major one being Traralgon. The population is 73,000 across the 4, but it is expected to grow up to 90,000 by 2036. And the median suburb price, a little bit dearer here, it's 531,000. The affordability, however, which is one of my favorite metrics, is 25.7 years to own. So still very affordable. And we're going to go through that. So let's have a look at an example of a property you can still buy in Traralgon under 500,000. So if we have a look here, so this was sold in November for 485,000. It was a 3-bed, 1-bath, 2-car garage on 556 square meters. So if we have a look here, it presents a lot of value. You couldn't buy something in many markets at that price point anymore. Now, let's have a look at the numbers of Traralgon. So if we look at the metrics, the last 10-year growth has been 94%. You can probably see a little bit of a theme here that most suburbs in the long run actually do perform pretty similar. So we've got, I think it was 110, something like 105, and now we've got 93%. They're pretty similar over a 10-year period. The 3-year growth rate has only been 8.3%, so it's severely underperformed Traralgon in the last 3 years. The stock on market, though, is tight. We're at 0.35%, super tight. And this is a little bit longer because it's a bit of a cooler market than the other 2 that I mentioned. It is at 68 days, but it is trending down, and that's what we've got to keep track of. Vacancy rate, 0.29%, so very tight, under 1%. Rented to owner ratio, very strong, 26%, so really, really strong. It means 74% of people are owner occupiers in the suburb. And the affordability, as I mentioned, is very strong at 25.73 years to own. So the most affordable local to incomes that we've seen across the 3 suburbs. Now, you remember I said it's a contrarian view, and the reason is there is a big stigma around the Latrobe region. The reason for that is traditionally, the Latrobe Valley has been a coal mining town, and it is associated with the coal industry, and it has a lot of shutdowns that have occurred over the last decades. So it does have a history of economic struggles as it has transitioned from a coal mining town into a more diverse economy. But a lot of economies don't stay the same and they can change over time. So here's why I think people are wrong, and the 3 reasons why I think that Traralgon is part of the Goldmine suburbs. The first one is the economic transformation. So Latrobe region is transforming from a coal industry to a renewable energy industry. And it's something that we're seeing across a lot of regions of Australia. It has the nation's first offshore wind farm, and it has a lot of renewable energy jobs that are created. And these are replacing the traditional mining jobs. And the agricultural sector there is really growing. The second is infrastructure, and there are a number of projects going on at the moment. We have the $233 million hospital upgrade. And as you can see, there's a bit of a theme there. Hospitals are really strong economic drivers of regions. The next one is the nation's first offshore wind farm, which is in construction at the moment. We have a government transitioning to renewables, and this one might not sound as important, but I did just read there is a Costco opening there, which is normally a good sign. You might have heard something called the Bunnings effect, and essentially when these large brands, they do so much research as far as where to put their next store, opening a Costco in the region is a really strong indicator for the future. And the third one is owner-occupier appeal. So Latrobe Valley is a beautiful region of Victoria. It's only 2 hours away from Melbourne. It's got V-line connectivity, and it's a nice, affordable place relative to local incomes for people to bring up their kids. And it's a great place for people to still be able to live the Aussie dream and afford their own house. As I mentioned, very affordable relative to local incomes. You can still buy brick builds, 3 to 4 bedroom houses on large blocks under 500,000. So why Traralgon does have a bit of a checkered past, you can see there are plenty of reasons to make it a Goldmine suburb, and it's not too late. In fact, it's quite early to get into this market now, as people still have that stigma But in 2 to 3 years, I think we'll look back and we'll see how much of a change it's really had. So I've given you 3 Goldmine suburbs under 500k. Now I'm going to give you 2 suburbs that I would avoid. And the reason I want to show you this is in contrast to the 3 Goldmine. I want to show you what 2 bad suburbs look like. And the funny thing is, these are 2 suburbs that a lot of investors are still buying in. Okay, so the first suburb and the first trap is Elizabeth in South Australia. So Elizabeth is a suburb in northern Adelaide, and it has been a market darling for the last 5 years. So I'm going to talk you through it. The median suburb price now is 671,000. The 10-year growth is 198%. So can you imagine that? It has grown at 19.8% for the last 10 years. The 3-year growth is 72%. So remember, the last examples I gave you was 8%. This has grown 72%. The affordability has blown out to 52 years. So it's going to take 52 years to pay off your mortgage if you live in this area. The stock on market though, and this is where you need to look at all metrics, it's still tight, 0.39%. So it's not going to stop growing today. It's just how much does it have left? Days on market is still at 35%. So it's very strong still. The renter to owner ratio though is 53%. So you can see as more and more investors have bought, the ratio has changed and it's now more investors or more renters than there are owners in the suburb. And the vacancy rate is now at 2.4% as a result. So you can see all the metrics start to line up and you can see it's an area that has grown too much. It's now become unaffordable. There's too many investors there, and over time we'll start to see rents soften, and I think we'll start to see prices stagnate and even fall. Let's have a look at another suburb in an area that I know everyone always talks about, and that is Brisbane. So we're going to go to a suburb now called Woodridge in Queensland. Let's have a look at it. So the median suburb price there is now 770,000. The 10-year growth is 161%. So you can see now a strong theme of how that looks. The 3-year is 64%, so great if you bought there 3 years ago. The affordability is 60.74 years to own. So you can see how a suburb can go from being affordable with a lot of growth ahead of it to being really unaffordable and limited growth ahead of it. Stock on market still very strong, so it's still a boom location, right? 0.46%. Days on market is at 19. It's as low as you can get almost. So it's still running really, really hot. And that's the mistake people make. They don't look at kind of what's ahead. They look at the now and think this is a great suburb to buy in, but it's already had so much growth. The renter to owner ratio, similar to the last time, it's now at 60%. So it's 60% renters, 40% owners. So the ratios have blown right out. And the vacancy rate is sitting at 1.2%. So it's still okay, right? It's not too bad, but I would expect to see that trend go upwards. Okay, so now you've seen 3 Goldmine suburbs. You've also seen 2 suburbs that I would avoid, but this is the most important part. For anything that I've shown you now, for any suburbs that I've shown you, you need to act now. If we look back at the track record that I showed you earlier, Eaton WA we bought, it had 175k growth. Gracemere we bought, it had 208k growth, and Clinton, it had 149k growth. And these were all Goldmine suburbs 12 months ago. So now they've had their growth, they're going to keep growing, but you can see the majority of the growth happens in the early days. And that's why the buying window in these suburbs is closing. We were buying in some of these Goldmine suburbs for some time. I'm already starting to see higher buyer activity, days on market's trending down, the stock on market is tightening, things are starting to change quickly. Right now, you can still negotiate and you can still buy under market value, but it won't be for long. So property investing rewards contrarian. So whilst everyone else is targeting the older hotspots, the areas that have seen substantial growth, you need to be a contrarian. You need to go against the herd. And that's why this year at Compound Property, we bought a significant amount of property in Victoria because it has been the market that has underperformed. So the best time to buy is when everyone's talking negatively, when the headlines aren't looking good and everyone thinks you're crazy. But the most important thing is you look at the data and you can see the fundamentals. That is why I'm suggesting that Mildura, Golden Square and Traralgon are 3 Goldmine suburbs that you want to be buying in now. So if you want help buying in any of these Goldmine suburbs, reach out to us at Compound Property Buyers Agency. We're an Australia-wide, data-driven investment buyers agency that help you buy high growth and high cash flow properties across the country to build out a property portfolio. As far as service, we'll work with you the whole way through from strategy, acquisition, ongoing management and beyond. There's a link in the description below. But whether you're going to work with us or do it yourself, the message is the same. Don't wait and sit on the sidelines and don't let the opportunities pass you by. Bendigo, Mildura and Traralgon under 500k. That's where the growth is coming and that's where you should be buying right now.